Hey guys, Stock Saturday, and it's a flat week for me, but a very mixed bag for me, especially, but sort of in the markets as well. FTSE 100 down quite a bit, Nasdaq up quite a bit, and the S&P sort of up slightly, a couple of percent. So, yeah, depending on what you're in, I've sort of seen a fair bit of losers sort of in the commodities and sort of a little bit of gain in some of my more tech stuff. I don't have a huge amount of tech stuff, so yeah, it's been a bit hit and miss, but yeah, not a lot of earnings this week, so I thought we would sort of have a look at a bit more macro stuff. So part of this volatility at the moment, sort of up and down all over the place the last couple of weeks, has been the banks. You've had sort of Silicon Valley Bank and Signature and Silvergate go belly up, and sort of thoughts of First Republic, I believe. Looks like they've been sort of bailed out essentially, and there's also worries about Credit Suisse in Switzerland. But you have had sort of the Fed come out and say everybody's safe basically, and it looks like they're sort of giving out loans rather than sort of bailing out the banks full on, and they're sort of using other banks' deposits basically to give out those loans. So they're saying this isn't really money printing, but you've had sort of the big four banks in the US, from the looks of it, deposit a load of money with the Fed, and then they've, I would call it, printed money and sort of given these banks a loan. If the sort of big four banks want their money back anytime soon, then obviously that money is now in existence. So I call that slightly quantitative easing. So the big banks have deposited 440 billion, it looks like, and they've given loans of 165 billion to some of these banks. So yeah, people are sort of seeing that as positive from what was a very down week last week. So yeah, interesting to sort of see where this goes. This is all sort of seeming quite positive for the crypto side, which you can see tomorrow. I do like to have a quick look at the US debt clock every now and then, just to sort of see exactly where things are and where they have been. So sort of key figures on here, lots of figures, but a couple of sort of key figures. You got the US national debt. This is the sort of main treasuries and everything, sort of main debt at 31.5 trillion now, and US GDP at 26 trillion, 26.2 trillion. So over 5 trillion more in debt than the whole GDP of the US. And you can also rewind and fast forward this debt clock to sort of various points in time. So if you sort of go 2020, you can see where they were. So you had debt sort of about 4 trillion more than the GDP. And if you sort of go pre-COVID, 2016, before a lot of this started, then you were at sort of pretty much 1-to-1. US national debt slightly lower than the GDP. So you can see what it has done to the country, and you can sort of fast forward to their projections. Obviously, 4 years away. This is a little bit, take this with a bit of a pinch of salt, but yeah, they're sort of showing GDP growing to 29 trillion, but US national debt to 44 trillion. So it's not going well, and you sort of have, that's the treasury debt that they absolutely have to pay. But you also have things like Social Security, which they sort of essentially have to pay later on, and sort of Medicare and other unfunded liabilities at sort of 236 trillion. So yeah, it's not looking too good, but everyone still thinks US is strongest country in the world. So we'll see where they go. So just looking at some of the commodities that are sort of weighing on my portfolio at the moment. I don't have a huge amount in gold. I do have some physical gold, but yeah, not a lot in gold miners, apart from sort of the silver miner exposure. They have some gold, but it's making sort of recent highs. This isn't all-time highs. That was sort of the just after COVID started. Got to around about $2,070. In pounds, it is actually quite high, obviously, since the pound devalued, but it's generally sort of measured in dollars. Obviously, if you're in the UK, then it has done reasonably well, and if you're in it, then you've avoided the devaluation of the pound. But yeah, it's doing well, riding high at the moment. Silver's a bit of a different story. It's not doing sort of too bad the last couple of weeks, risen up to about 22.6, $22.60, and yeah, it's sort of quite a way off the previous highs of 2020, but this is also a way off the sort of 2010, 2011 bull market. So this is when gold got to about 1920, I think, $1,930, and silver ripped right up to sort of $48, nearly 50, I believe, sort of in some markets. And so yeah, when it goes, it really can go. And at the moment, you've sort of got it sitting at, people do look at the gold and silver ratio, so how many ounces of silver you get to a gold ounce, and that's about 90 at the moment. So previously, sort of decades in the past, that has been sort of closer to 30 times, 20 times. So yeah, you could see this a lot higher if it were to revert to those sort of levels. Sort of 20 to 1 would be more like, $95 silver, which is probably not on the cards anytime soon, but yeah, nice to sort of see where we have been in the past. You did have a large spike in the 80s, actually, which got to sort of, I think, again, this sort of doesn't quite show the whole move, but I think it was $50 even back then, but that was an episode of sort of manipulation looking back in history. So yeah, be interesting to see where this goes, and sort of if it follows gold to sort of potentially new highs. Again, I do sort of have quite a fair bit of physical silver, actually, sort of liking the industrial side of it rather than just sort of monetary. It's sort of used in electric cars and solar panels and all sorts. So yeah, as we move sort of a bit more green, then hopefully it should pick up. Copper doesn't really sort of seem to know what it wants to do. It's risen up sort of off the lows of last year on the China reopening, it seems, and sort of having a little rest now at sort of just under $4. $4 isn't a sort of terrible price for a lot of the miners. So I've got like Atalaya Mining as a sort of pure play copper miner. They're doing okay, sort of even at these prices. But I mean, if you look sort of pre-COVID levels, obviously we sort of went mad towards about a year after COVID started, and it sort of went to $4.50, $4.80. But sort of pre-COVID, you were in the really $2 to $3 range for sort of large parts, even sort of 10 years back, $2 to $3. So to be, at just under $4, sort of the lows were $3.25. Not too bad. Obviously, costs have gone up a great deal since then, so yeah, maybe they're not making much more profit than they actually were, at sort of $3, $2.50. But yeah, again, a green sort of story with copper, wind farms and solar panels and everything. Copper's sort of used in practically everything. Iron ore doesn't seem to be having the same pullback that copper does, just sort of certainly slowing down. You can see this sort of curve really sort of slowing down as time goes on, but it's still rising, and yeah, up to sort of 132. Again, the highs of that were sort of mid 2021 at 220 odd. So yeah, long way to go to get back to there. I can't imagine we'll see that anytime soon, but 130 isn't terrible compared to sort of the lows, and potentially people think we're in recession. So yeah, I thought this nice little rise was pretty good. Sort of all time, it's very rocky. It's been sort of higher than now, sort of over a decade ago. So yeah, we'll have to see how this goes. But certainly, people like Rio Tinto and Vale have sort of been absolutely hammered the last sort of couple of weeks, and sort of I didn't really see why, especially being sort of vast majority iron ore miners. So with these prices, unless they're expecting a drastic decline, I thought possibly they are a buy. Then finally, one that isn't looking happy at all is oil. So this is Brent crude. I don't tend to look at crude oil, just WTI as they call it, the American one, because people don't really seem to sort of pay attention that Brent is the sort of vast majority of the world's oil, and how sort of the vast majority is priced. But because sort of most financial coverage is American, they focus on WTI. So when people say oil, they generally mean about a quarter of the market. So I look at Brent, and that's down at sort of $72. Not a very happy place compared to sort of where we were. Obviously, that's was partly due to the war, and sort of again pre-COVID levels, we were at sort of not much above, or not much below where we are now, to be honest. So yeah, it's been sort of higher than here before, sort of 120s and 140s in the sort of highs of, well, back in the recession, really. So it was a bit strange, but yeah, be interesting to sort of see where this one goes. My Shell position sort of took quite a hit this week, down nearly 10%, I think. Obviously, gas as well is not having a happy time, so they're looking to transition to more green materials. We'll have to see, though. Oil still sort of, I think, has quite a long future, sort of plastic use and various other things still increasing, and yeah, oil use for sort of cars and planes and that sort of thing isn't, falling off a cliff just yet, even with the rise of electric. So yeah, I think that'd be fine. And then just having a quick look at the news, you've had on Tuesday unemployment for the UK. This is January, so not quite up to date, but that was expected to go up, and it stayed flat, 3.7%. But then the big one, CPI numbers for the US, core CPI month on month is sort of the one that I would be focusing on, and that was 0.1% higher than expectations, 0.5% year on year, unusually sort of was as forecast. Not quite sure how I guess that's just a rounding error. And the ordinary CPI 0.4%. Then Thursday, you had the weekly job numbers, sort of unemployment claims back down again, when lower than expected. Initial claims sort of down and lower than expected. So, yeah, that and the CPI going up, you can probably expect a 0.25% rate rise coming on Tuesday, I believe it is, Tuesday or Wednesday. So yeah, be interesting to see sort of what he says after the meeting. I think it's probably going to be a 0.25%, but whether he says, anything about the bank failures and that sort of thing, maybe he'll sort of think we need to just have a pause at least and see sort of how this all plays out after a 0.25% rate rise. Obviously, if he does do like 0.5%, then everyone will sort of go mental, and we'll probably have a fair drop. If he does pause now and not even do 0.25%, then everything I expect will rocket up, even though he's sort of doing it for bad news. The sort of bad news is good news these days. And then you had the European Union ECB rate go up 0.5%, sort of as expected. So they're still behind the UK and the US, but yeah, there you go. And Friday you had EU CPI numbers, sort of pretty much as expected, although sort of core CPI is actually on the rise. So yeah, 0.8% for the month and 5.6% on the annual, up from last month. So you can see why they're still rising. But yeah, that was pretty much the news. So as I say, portfolio-wise, sort of bit of a mixed bag. Your Rio Tintos and Vales and Glencores are all getting hammered, and Shell as well. But yeah, things like Broadcom at practically all-time highs. I'm actually including the FX move, which I don't sort of include here. I'm actually at 60%, excluding dividends on Broadcom. So it's one of my longest holdings and has been sort of one of the best, other than Shell, which has now come down below 100%, but with dividends on top, that would be more than 100% return. So that's good, but yeah, dropping down. Still don't know what to do with this £1,000 cash. Sort of was tempted to sort of withdraw that and put it into crypto, but with that sort of rising up recently, kind of not so tempted. And yeah, I've still got my 13,000 in treasuries. That has gone sort of, it went green and then it's gone back into the red because it's gone ex-dividend. So I think I'm sort of £28 in the red, but I think I'm due about £170, I think, or something in sort of dividends from that distribution. So yeah, that has, with the bank sort of failures and everything, that has gone green. So yeah, potentially sort of thinking with some of these drops, I might be selling some of that and buying something. And I did get a little £45 dividend from Tritax Eurobox. But other than that, not too many moves, I don't think. The 3x short Nvidia is sort of crashing into the floor. A very, very wrong decision from me. I really didn't expect Nvidia to sort of be doing this well on basically just AI hype, because the rest of the business doesn't seem to be doing particularly well. But I think people are thinking they're going to be a $1 trillion company again, purely based on selling AI chips. So we'll see. I still don't agree, but yeah, I'm not going to sell it now just for 370 quid. So I'll just let it run. And then, yeah, you've had sort of a reasonable move up in things like Hive blockchain, with the crypto doing well. Silvergate Capital gone bust, so leave that 90 quid there and see if anything can be salvaged of it. Atalaya Mining doing okay, but has come down. And yeah, the Chinese tech, sort of Alibaba is quite a bit down, and Baidu is up about 10% for the week, sort of off the back of AI, really. They sort of have a competitor in the sort of chat GPT type AI bots, and sort of they showed it off and it looked quite good apparently. So yeah, I was reading a bit of reports and yeah, that sort of pumped reasonably well on that. So I do like having that sort of multiple bets, as I said last week, sort of self-driving cars and AI, as well as sort of the search and other things. So quite a nice little company for sort of, what is it, 50, just over 50 billion. I think you get quite a lot in there compared to sort of other tech companies being sort of hundreds and hundreds of billions. So yeah, that's the portfolio for the week. As I say, flat but interesting. Let me know how you guys are doing, and like and subscribe. See you soon.